Hey fools, welcome to the series premiere of Digging for Value. I'm Taylor Muckerman here with Mike Olson and Joel South. And we're going to be covering natural gas topics in this segment. And Joel, right off the top, we want to get into some news about coal plants shutting down in favor of natural gas.
Yeah, definitely. FirstEnergy is the newest utility that's coming out and shutting down plants. They're basically looking at two plants, coal-powered plants, that they're looking to shut down. They're not going to go out and move these into natural gas. They're just finding that really coal is unprofitable, especially with a lot of future environmental concerns. And if you look at the amount of the coal portfolio in electric generation, once you hit that 40-year peak, you really start seeing the costs rise, and you start seeing the production, electricity production start decreasing. And if you look at the total production in the coal industry, if you over the last few years, it's really moving towards that 40-year percent. I think about 43% of the electricity being generated is from coal plants that are past that 40-year mark. So if that's true, and a lot of companies are worried about the environmental concerns and the future costs, they're basically going to look at their future position and maybe start making the same decisions that we saw here, where they're not going to go out and increase their coal capacity. So, if you look at that, that really gives a nice boost to natural gas as a long-term viable source to fill in this space. And you're seeing a lot of big companies move in here. Southern Company, for one, they basically went from producing a pretty small portfolio of natural gas electricity. They're now upwards at different times of the year, can go up to 50-55%. So obviously, this is a nice boost, and if other utilities make the same decision, natural gas could have that boost, that consumption boost, that might be able to move it out of that price range.
Range right now where coal and natural gas companies can't really decide which way to go. They either have to expend money to gasify their coal or to add scrubbers, which is very expensive, and natural gas is kind of rising in price, so becoming uneconomical for them there. You look at Duke Energy moving the same way, more towards natural gas, less from coal. You look from 2005 to 2015, they moved from 55% coal to 38% coal was what their goal is in the next couple of years. So I think you're going to continue to see this moving forward. And then now you're looking at natural gas producers who have struggled recently from prices being low, and then you have to become diversified, and you have a diversified natural gas producer who really hasn't performed like you would expect, but you believe they're undervalued and they've got some good things working.
Right, yeah, Devon Energy, I own the shares, disclosure. This is a company that really has been, it's kind of a Frankensteinian E&P in that nobody really knows how to think about it. It's largely thought of as kind of a hulking behemoth, which is more or less natural gas. 60% of its production is natural gas, but that discounts the fact that 40% of their production comes from oil and natural gas liquids, and in fact, they derive the majority of their profits from that. They have a great portfolio of properties in the Permian Basin, Canadian oil sands, Woodford-Cana, and the liquids-rich window of the Barnett. This is a management team that historically has really been focused on creating value for shareholders instead of engaging in the whole land grab and chasing growth as many of their peers did during the right leading up to the credit crisis and even thereafter. They actually divested some of their international assets because they realized that they had a portfolio that they just couldn't properly develop. It's a very savvy move on their part, and it's been, in my opinion, accretive to shareholders. Right now, it's kind of been left for dead just because natural gas prices are in the dumps. They have consciously deferred natural gas production, which I think is actually a very smart decision because the economics don't make a whole lot of sense even at $4. They probably make money across their portfolio at $3.50 per MCF, but that's still, on a full cycle basis, not a very attractive return on capital. The reality is that they have the capacity to grow at a pretty meaningful clip. They've grown their oil production at about a double-digit rate for the past several years running. They will continue to do that, and as natural gas prices recover to at or around maybe $4.50 on a sustained basis, I think you'll start to see them adding natural gas production back. So, you really have upside from 3 or 4 sources here. The first is higher natural gas prices. You're going to see higher natural gas liquids prices, in my opinion. They have a pretty large percentage of their oil production from Canadian oil sands right now. That's been depressed. As you see infrastructure built out to Canada, I think you're going to see that move higher. And then there's kind of a cherry on all this. Management realizes that their share prices languish for some period of time, and relative to their peers, it's just not a very attractive valuation. And they've said that basically all options are on the table with respect to recognizing value. They're actively looking at monetizing just about any of their assets. I think their Canadian oil sands are worth in excess of maybe $15 a share alone. And their midstream assets, this is infrastructure, I think they're worth about $10 a share. That business does $450 million in operating profits. They have plans to IPO that as an MLP. Joel, you're going to be talking about them later. That should attract a lot of interest among the investing public because we've seen great appetite for yield lately. So, you know, in aggregate, I think it's a very attractive investment which has multiple sources of upside right now.
I think so too, especially with that natural gas waiting in the wing, like you mentioned. They've suffered from asset impairments over the last year, leading to a net loss in 2012. A lot of investors kind of overlooked that, but the cash flow is there. And I think that once the natural gas prices rise, this company has definitely got some upside. And now moving on to some cheaper producers who have been able to kind of wade through the lower price mechanism here that we've seen with natural gas a little bit better. Joel, you've got some ideas in mind.
Yeah, definitely. If you look at some of these sole natural gas producers, really, if you look at the spot price right now, they're the only ones that can really turn a decent profit. And there's a few that I really like. Actually, two companies that I think are very, very great operators, really expanded a lot of their natural gas, pretty diversified. Cabot Oil and Gas is a very solid player. So is Range Resources. However, there's two companies that I really like in this space. And really what I like about them, they're basically right now almost primarily producing in one play. What that means is, as they start expanding, there's a lot of people that are kind of discounting them because it's a hard move to go into a new play and still keep the same economics. So they're a little more discounted than some of these other low-cost producers. And the first one I want to talk about is Ultra Petroleum. This is one of the very low-cost producers in the area. Right now, they're primarily in the Wyoming area. They have really good assets in Pendale, and they've been doing really great things with them, very economical. As you look forward, they're trying to move into the Marcellus. So if they can go out and do similar things that they've done in the same area, basically they've lowered their spud-to-spud time by over 60% in the last 5 years. Also, they've lowered their well costs by up to close to about 20% over the last 5 years as well. So obviously they're very nice. However, if you look at that company compared to Southwestern Energy, who I also really like, they're doing the same thing. Right now they're in the Fayetteville Shell, and they have been actually one of the very lowest producers, and they're also looking to move into the Marcellus. They have about 20% of the reserves there, 9% of their production right now. So they're also looking to go in and do the similar things. And this company, over the long term, has really been focused on going out and drilling so they get that held by production. Now they're really starting to go in and increase their efficiency, lower their costs. So if they can go out and do this, I think those two companies are by far the best low-cost producers to play the long-term natural gas game.
It's really interesting to see them being low cost because you have Ultra Petroleum up in Wyoming, and then you have Southwestern down in Arkansas, but both operating very efficiently. And then you saw natural gas prices climb to around $4.50 per million BTU in April, since fallen to $3.60, $3.67 right now. So obviously continuing in the importance of cheap natural gas production. And then now turning on to a global natural gas producer, also pretty heavily into oil, but they've really been kind of pulled back by some international affairs.
Right. So we're talking about Apache right now, which is basically their production mix is maybe 50-50 natural gas and oil. They have a very, very large diversified asset footprint. They are just about all over the place. They're in offshore Gulf. They are in Africa. They are in the Middle East. And they're also, predominantly they're in Egypt.
Right.
And this is really the source of concern. They derive about 20% of the cash flow from there. And of course, with the political unrest there is a huge amount of concern regarding what the prevailing regime will be, their ability to earn a reasonable return on that, and whether or not the regime itself will be friendly to them. Now, my personal belief here is right now, when you look at the share price, it's about $80 a share. The market has more or less discounted the possibility that they will lose these assets or they will not earn any money on them for the foreseeable future. The likelihood is that I think whoever the new leadership ends up being, they recognize the importance of foreign direct investment and that this is going to be a key driver of Egypt's economy moving forward. Elsewhere, they have great prospects in Australia. And I think that and some of their investments in LNG terminals in North America should allow them to realize international standards on natural gas prices, which will be excellent. It could be an absolute boom for them within the next few years. And last, because 50% of their production is stateside natural gas, or the majority of it is, they have a nice little call option on higher natural gas prices. This is something that, it's a little bit spicier because this is going to be kind of a chronic discount. I would imagine the Egypt thing, this is not something where we'll see a resolution too soon. But certainly the shares are reflecting a good bit of pessimism on that account.
Yeah, and with a company that's arguably trying to spend, or divest $4 billion worth of assets over the next year or two. You can possibly see them follow along in the Devon mold, where they obviously get away with a lot of their international assets. I do like this company a lot. Unfortunately, international markets have weighed on them heavily. Argentina is another one. You saw YPL get nationalized down there, but obviously some huge production potential with natural gas and shale oil reserve. So we'll continue to watch Apache and see if they can rebound from their low stock price valuation. Turning back to MLPs, as you mentioned earlier, Joel, you like this as a dividend player. Even with yields rising, you see MLPs as a positive space here.
Yeah, sure. When you're talking about dividends in the MLP space, I really like this space. One reason is you basically skip the double taxation. A lot of the cash flows go straight to the unit holders, so obviously you're getting higher distributions. What I like about natural gas, if you look at the MLP space and you look at risk, coal will have the highest distributions. Obviously, it's a more risky industry right now, and oil is significantly lower. A lot of the good MLPs, you're basically looking at around a 4 to 5% yield. Natural gas, you can get higher. One of the companies in this space I really like is Boardwalk Pipeline Partners. They're close to about a 7% yield right now. And really what I like about this company is they have great assets connected throughout really the key spots in the United States where the natural gas production or natural gas pipelines are flowing. You're basically connected pretty heavily into the Gulf Coast. Obviously, there's a lot of markets there that you can reach through exporting, and also tied into a number of players, power generating facilities, either natural gas or aging coal facilities in that area. And right now they're controlling about 12% of the United States natural gas consumption. So obviously very solid. When you look at what they're doing, they're contracts, 83% of them are fixed fees, so basically you can guarantee the money coming in. Obviously that helps you out knowing that your distributions are safer than a number of other areas. They're also investment grade, which means their cost of capital is very competitive with a number of other companies. Or better. And what this is important because the only way to really grow your distribution is either to grow organically or buy more pipelines to drop down. So obviously having a lower cost of capital is extremely beneficial here. So when you look at in the natural gas space, I think this is one of the best companies for that high distribution. They've never cut it since their IPO in 2006. Great management, so it's definitely a solid company.
Yeah, it's a company that has assets in a great portion of the country for natural gas assets. And then if you want to look at a more broader scope, you can turn to the Kinder Morgan Energy family with the partnerships there, Kinder Morgan Management and KMP. Two different ways to play the MLP space, but they have pipelines all across the United States and Canada, so a little bit more diversified, more stable dividend in my mind, but obviously some growth opportunities for Boardwalk, so some differences for investors to take a look at there. And then next we want to turn to some companies outside of the natural gas sphere that could benefit or potentially be hurt from natural gas price fluctuations.
Right. So I think there's kind of one of my favorite quotes from a guy named Rick Rule is the cure for low prices is low prices. And I think you kind of see this dynamic at work in the rails, somewhat counterintuitively. They compete, of course, with trucking for long-haul transportation. The rails have been placed in a very nice position over maybe, I guess, of course, the past decade on account of the fact that they've really gotten their act together via consolidation, intelligent use of technology, upgrading the rail infrastructure, and improving their safety record. That, in conjunction with high oil prices, has put them in a great position as a cost advantage player for long-haul transport. It's estimated that they're about 3 to 4 times more fuel efficient than long-haul trucking. And so the idea here is that even if long-haul trucking were to convert to natural gas on kind of en masse, they are more or less at energy equivalency with trucking, or perhaps cheaper, as it relates to the overall cost. Sure. And of course, if trucking were to use natural gas in larger quantity, you're going to see higher prices. I believe natural gas is relatively undervalued right now. In order to justify production, you need to have higher prices. So CSX right now is somewhat interesting in that they're poised to benefit from that. Their position on the East Coast, and so they basically move about 2/3 of the nation's freight. And in particular, I think you're going to see them gaining a lot of share in intermodal. The one thing that has kind of, I guess you could say it's labored on the stock recently, is they're perceived to be a coal company. About 27% of their revenues last year came from coal. The reality is I think you're probably going to see coal declines over the course of the next decade or two, but the stock pretty adequately discounts that risk. And in fact, when you consider their growth prospects and their ability to increase prices, understanding their cost advantage position, I think that the stock more than reflects that risk, and it's a relatively attractive buy right now.
Yeah, and you talk about the long haul adapting to natural gas, and Westport and Cummins and their joint venture with Long Haul Engine Construction are really doing their part to push that along with some pretty rapid adoption. And then you have clean energy fuels building out their natural gas highway. So that's obviously going to provide nice infrastructure for these trucks to highlight with. And then also trains might even get on this natural gas action with Warren Buffett coming out saying that his Burlington Northern Railway might start experimenting with natural gas and locomotive use. So even that could drive up the cost a little bit, but I still think it would be competitive with diesel for these trains. So we'll continue to see how transportation decides to move forward with natural gas and increase those prices as more and more demand takes place. And then finally, when we want to wrap up with some companies in the natural gas arena that haven't really performed as well from either an operational standpoint or from a management perspective.
Yeah, there's a number of natural gas players that were really hurt. If you look over the last decade or so, high natural gas prices, new technologies, you could go out and frack new unconventional shells, basically led to a lot of companies going out and buying these assets. Once they started drilling, they had to drill to hold their held by production their assets. Basically, overproduction, the price of natural gas plummeted last year to pretty much record lows. Hurt a lot of these companies. So basically, two companies that are hurt that still have a ways to go, but do have nice assets that I think hold long-term value. The first one is Chesapeake Energy. This is one company that has been in a proxy battle as well. They recently exed Audrey McClendon, their old CEO. However, when you look at this company, they do have a funding gap that they're trying to close over the long term. Basically, this year they're looking at $3 to $7 billion in asset sales. They've about $1 billion short from that first level. But they have great assets. Like we mentioned, they have top plays and 10 really nice assets in North America. And then they're really focusing on oil heavy. So basically 75% of their capital expenditures is focused on the Eagle Ford, the Anadarko Basin, and a little bit in the Utica. So basically they're going after those high rates of return plays. And then if you look at what they're doing on the cost side, their capital expenditures are down 43% this year. So long term, I think they have great assets. Once they get past that next funding gap, they're a great play at a pretty heavy discount right now. Another company, Sandridge Energy, very same thing. Proxy battle recently got rid of Tom Ward, their CEO. This is another company that has been beat up through that, and also they've basically turned their company into kind of a one-trick pony. All their assets, or the majority of their cash flow, is coming from the Mississippian Lime. Later last year, we saw that the Mississippian Lime, a lot of the wells they were drilling, were actually producing more natural gas than they hoped. So they obviously were hit from there. But if you look at the Mississippian Lime, they still are getting outstanding returns. They're really the cost leader in this place, and the reason is they have the disposable salt wells and the electrical infrastructure. So they're basically looking at getting their well costs below $3 million by the end of the year, which is phenomenal. Nobody else in the space can really even touch that. So when you look at this company, what they're focusing on, they're trying to cut their costs just like Chesapeake was, but their production is coming right in that infrastructure, so they can only target the really efficient wells. And it's a longer, slower build, but it has long-term value, and it is a cheap play right now. So if they stick to it, they don't really have a whole lot of payments soon. Their revolver payment is due in 2017. Long-term debt is kicked out a few years, so they have time to grow, and if they do it smartly, I think there's a lot of value.
Yeah, it was a perfect storm for both of those companies with management shaking up and financial instability. So it's actually taken a little bit longer than I think investors were looking for. But hopefully things will start to shake back up for them in the next year as natural gas prices creep up, as I think we can all agree on they probably will. So Fools, thank you for tuning in to this first episode of Digging for Value. Be sure to tune back in on a weekly basis where we'll cover energy and materials investing ideas and keep fooling on.